Picture this. It's December 1989. You're Haruto, a 28-year-old office bloke in Tokyo. Your boss works for a mid-sized electronics supplier. You're based in Shinagawa, pulling in 4 million yen a year, about $30,000, while your Mrs. Yuki works part-time at a department store in Shibuya. You've just done the smartest thing a young Japanese couple can do, bought yourselves an apartment. This two-bedroom place is in Chiba Prefecture, a 40-minute train trip from central Tokyo. It cost 42 million yen, about $300,000. You put down 8 million yen and got a 3-5-year loan for the rest. Monthly repayments are 120,000 yen tight, but manageable. All your mates are doing the same thing. Your old man reckons Japanese land values have never dropped, not once, since the war ended. They call this idea Tochi Shinwa. The land myth is no joke. It's as much a part of Japanese life as cherry blossoms in April. On the 29th of December 1989, the Nikkei 225 hits 38,957, its highest ever finish. Apparently, the Imperial Palace grounds in Tokyo are worth more than all the property in California put together. Golf club memberships go for hundreds of thousands of bucks each. Mitsubishi just snapped up Rockefeller Center in New York for $1.4 billion. Sony just bought Columbia Pictures for $3.4 billion. Japan's on a shopping spree around the world. Yuki asks Haruto if they should have gone for a bigger apartment. Prices keep going up. If they wait, they'll never afford one. Haruto reckons they made the right call. They're expecting the apartment's value to go up by next year. Yeah, that's always how it goes. Now have a look at what goes down 34 years down the track. Not 34 months, but a full 34 years. The Nikkei will eventually come back to the level it was at the day Haruto signed his mortgage. Their apartment will be worth less than half of what they originally coughed up for it. And Haruto'll still be paying back a loan for a home that's been worth less than its debt for 30 years. This ain't a story about a currency crashing. Most economic crashes on record see inflation wiping out savings. This yarn's the complete opposite. This is what happens when prices drop, wages flatline, and debt stays the same. Instead of a sudden collapse, the system slowly wears you down over the decades. This is the story of Yuki and Haruto, the deflation trap in action. Stick with me. The crash kicks off in January 1990. The Nikkei nosedives from 38,900 down to 33,000 by March, and by October, it's under 20,000, a 48% drop in just 10 months. Haruto watches this from his office. His company's share price has also taken a hit. His mates are worried. But he doesn't own shares, he owns an apartment, and property's a different story. Land prices had never dropped before, but now they're going down. Tokyo residential land prices hit their peak in 1991 and then start a decline that doesn't see a single year of recovery. For 14 straight years until 2004, Tokyo land prices dropped about 65% from their peak. In commercial areas, the drop gets as high as 87%. The apartment Haruto bought for 42 million yen is worth 25 million by 1995. By the year 2000, the property was valued at 20 million, but he still owed 30 million on the mortgage. He owes more than the apartment's worth, so he's stuck in negative equity with no way out. If he sold, he'd have to face up to the financial loss. Defaulting would wreck his credit score and mess up his reputation in Japan. Going bankrupt comes with a social stigma that Americans just can't wrap their heads around. Every month he's still forking out 120,000 yen on an apartment worth less than what he owes. Back in 95 and 96, the financial system started to show cracks bit by bit. The Houston specialized housing loan companies went bust, 7 of them, weighed down by 8 trillion yen in bad debts. The government bailed them out with 680 billion yen of taxpayers' money. First rescue of its kind, and it really ticked people off. And it wasn't the last time. On the 24th of November, 1997, Yamaichi Securities, one of Japan's top 4 brokerages, set up in 1897, and now 100 years old, called it quits. The company's president, Shohei Nozawa, held a press conference that's become one of the most replayed moments on Japanese telly. His voice all shaky, tears streaming down his face, he bowed and said, "Sorry. I'm sorry. Our workers aren't to blame." 7,500 workers lost their jobs. That same month, Hokkaido Takushoku Bank, one of Japan's top 20 banks, went under. In 1998, it became the first big bank in Japan to fail since World War II. The Long-Term Credit Bank of Japan and Nippon Credit Bank both went belly up, so the government took them over. By the late 1990s, Japan's banks were sitting on about 100 trillion yen worth of bad debts. Loans handed out during the bubble were never going to be repaid, but the banks didn't foreclose. They also wouldn't write those losses off. To steer clear of defaults that'd force them to fess up to the damage on their own books, they keep throwing loans at companies that are already bust. In Japan, they call these zombie companies, businesses that are technically dead but kept alive with constant refinancing. According to some reckon, between 15 and 25% of Japanese firms in the two are zombies. These companies suck up credit that could have gone to healthy businesses, they drag wages down, and they choke off new ideas. These mobs keep the whole economy stuck in a weird sort of limbo. And this is the thing that makes deflation different from inflation and more dangerous. And it's something you blokes on this channel really need to get your heads around. With inflation, it goes like this. Prices go up, and after a bit, wages follow suit and rise too. Borrowers get a leg up because paying back their debt gets easier. You owe a fixed amount, but the money you're paying back is worth less and less. It's the savers who cop it in the neck. The trick is to have real assets while you're in debt. With deflation, the whole thing turns around. Prices fall, wages either flatline or drop, but your monthly loan payments stay the same. Haruto realizes the real burden of his mortgage gets heavier. Sure, the yen he earns now can buy more stuff, but his pay is smaller, and the amount he owes in yen hasn't budged. The average salary in Japan peaked in 1997 and hasn't recovered for over 25 years. When you adjust for inflation, a white-collar worker in 2020 ended up with less in their pocket than a worker did back in 1997. For most of the years, from 1999 to 2012, consumer prices either dropped or didn't move. That's the longest stretch of deflation any modern economy has ever had. In a developed economy, the Bank of Japan dropped interest rates to zero in February 1999, but it didn't do a thing. Economist Richard Koo figured out the cause and called it a balance sheet recession. Both businesses and individuals stopped spending and taking on new debt, and instead focused on paying back the debts they'd racked up during the bubble. Even though interest rates were at zero, nobody wanted loans, because anything you could buy with borrowed money was losing value. Stashing your cash and paying down debt makes sense when there's deflation, but if everyone does it, the economy just keeps shrinking. This is what we call the deflation trap. It rewards being careful, saving, paying off debt, playing it safe, and punishes the stuff that'd actually get the economy going again, like spending, borrowing, and investing. What's smart for one person turns into a total disaster for everyone. Here's how that played out for a whole generation. Kids who finished their studies in Japan between about 1993 and 2005 came out to a job market that was totally frozen. The whole backbone of Japan's corporate culture after the war, lifetime employment, where a company'd hire you at 22 and keep you till you're 60, started crumbling. Businesses stopped taking on permanent staff. Instead, they offered short-term contracts, part-time gigs, and temp work. Young people who took those jobs got called freeders, a mix of the English free and the German Arbeiter, which means worker. By 2003, about 4.2 million Japanese aged 15 to 34 were in that boat. Over their whole lives, they'd earn around 106 million yen, while permanent employees pocketed 214 million, less than half. Yeah, less than half. Others just totally checked out of society. In Japan, they're called hikikomori, people who holed up in their rooms and stopped interacting with society. The official government figure is over 1 million, but by the 2000s, some researchers reckon the real number's way bigger. During those lost decades, Japan's suicide rate went up every year, hitting a peak of 34,427 deaths in 2003. Financial trouble, unemployment, debt, and bankruptcy kept popping up as the main reasons. The Aokigahara Forest, at the base of Mount Fuji, became internationally known as a place for people who'd given up hope. A lot were middle-aged blokes who'd lost their jobs or businesses during the long economic slump. This generation, the Ushino Wareta Sadai, or Lost Generation, didn't cop a sudden currency crash or banks being seized overnight. Instead, they went through something more subtle and in some ways more devastating, a slow fade of opportunity. That feeling when the old rules your folks followed, working hard, buying a house, and saving up, just don't pay off anymore. What happened in Japan's deflation is the total opposite of every other situation we've talked about on this channel. First up, cash. In any inflation crisis, cash is the first thing to get wiped out. In deflation, cash is king, and the yen in your pocket gets more buying power each year as prices drop. Japanese families instinctively understood this. Their savings rate, already high by global standards, stayed high through the lost decades. The tradition of tansu yokin, basically keeping your savings in a dresser drawer, went on. About 30 to 40 trillion yen was stashed in home safes and drawers, not in banks. In deflation, holding cash at home isn't a losing move. It's actually a winning one. Japanese government bonds gave steady positive returns over the lost decades as interest rates kept falling. A bond bought in 1990 with a 3% coupon became more valuable as rates dropped to zero. That might sound wrong if you've heard government debt is risky, but in deflation, lenders actually come out on top. You gave a loan at a fixed rate. The repayments have more buying power than what you lent. Every year, the borrower pays you back in yen that's worth more than the year before. Thirdly, those who didn't buy at the market peak and people who chose to rent instead of buying in 1989 kept their capital safe. They were able to make a purchase later on. The exact same apartment for half the price. 10 years later, people who rented were laughed at during the bubble, with everyone saying they'd never own a home. The renters turned out to be the smartest investors in the room. Fourth, people who avoided debt. The real disaster of Japan's lost decades wasn't crashing stocks or falling land prices. It was the debt taken on at bubble prices that could never be paid off. Haruto's mortgage was the trap. A family that kept their savings as cash, rented their home, and steered clear of debt came out with their spending power still intact. Every year, deflation made each yen they saved worth more. Have a look at how this turns everything you think about surviving a crisis on its head. In most economic slumps, cash is the first thing to let you down. But in Japan, cash actually came out on top. In your usual crisis, borrowers win because they pay off their debts with money that's not worth as much. In Japan, borrowers copped it because their income went down, but their loan repayments stayed the same. In most financial meltdowns, the banks rip off the savers. In Japan, the banking system got frozen solid. It didn't rip off savers. It just sat there doing nothing. The deflation trap is basically the flip side of every inflation scenario. The bloke who's bracing for a currency crash is stacking up gold and silver and moving his wealth out of banks. He's got to realize that the exact opposite situation is real. Not every crisis is like Weimar Germany. Some are more like Tokyo. The thing isn't whether your currency will cop inflation or deflation. The thing is whether you're prepared for either one. On the 22nd of February, 2024, the Nikkei 225 finally smashed through its all-time high from 1,989. It took 34 years and 55 days after the bubble burst for the index to close at 39,098. That's 141 points above the old record. Haruto chucked his money into the Nikkei index on the exact day he settled his mortgage and held onto it for 34 years. In nominal terms, he'd have pretty much broken even. Even after you factor in inflation, which wasn't huge in Japan, his returns still wouldn't have kept up with the value of his flat in Chiba. It was bought for 42 million yen back in 1989, but by 2024, its value had dropped to about 25 to 28 million yen. After paying the mortgage for 35 years, which came to around 50 million yen in principal and interest, he ended up owning the house outright. Its value ended up being less than what he first paid for it. The overall loss is basically the purchase price plus interest, minus what it's worth now. That came to roughly 25 million yen, which is around $170,000. Yuki stopped wondering if they should have bought a bigger place. What Yuki and Haruto's experience shows is this. Right now, most viewers on this channel are bracing for inflation. They're stacking gold, grabbing land, and holding on to physical assets because they reckon the dollar's going to drop and their call could be spot on. But Japan shows that the opposite situation actually exists. It lasted 34 years and absolutely smashed a generation that followed every piece of advice their parents gave them. As of late 2025, U.S. household debt is sitting at around $17.7 trillion. A big chunk of that debt is for homes bought at or near record high prices. Within 2 years, mortgage rates jumped from 3% to over 7%. If home prices fall, not a total bust, just a drop, Millions of American homeowners could find themselves in Haruto's situation. They'd owe more than their property's worth, can't sell or refinance, all while making fixed payments on an asset that's losing value. That scenario isn't hyperinflation, nor is it a bank panic or assets being seized. What it boils down to is a gradual, silent chokehold. Plus, it's the one situation gold, silver, and property can't shield you from, because in deflation, the most valuable asset is the cash you've already got. The question Yuki and Haruto are asking isn't about what to hold when the currency collapses. Instead, they're asking the reverse. What happens when the advice you got? Buy a house, get a mortgage, invest for the long term. Turns out to be a 3-4 year trap. In Japan, the fix was exactly what every finance expert calls useless. Cash left, sitting in a drawer. Every single year, its buying power kept going up, while every other asset in the country was tanking. If you're a viewer who holds on to gold for inflation and cash for deflation, you're set for either scenario. If you only keep one mate, you're basically betting you can predict what's coming. Haruto's old man put all his chips on one result. He was right for 44 years, then wrong for another 34. The real drama ain't what keeps going up all the time. It's what happens when that upward trend finally stops. Make sure you hit that subscribe button so you don't miss the next video.